Welcome to the March 2018 Economic Update. Before we begin, please just recognise that statements in here are to be considered general advice. If you are thinking about acting on information in this presentation, please consult with your financial advisor first. The other thing I'd like to say is we have a new member to our team, Mr. Callum Glasby. If Callum does talk to you or you receive an email from Callum within the next couple of months, please welcome him aboard. The other thing I'd like to say at the outset is Morgans has quite a large and diverse analyst team. This is just the picture of our Sydney team. These teams are duplicated across Melbourne and Brisbane. Their main roles in their areas of expertise is to negotiate and discuss with the business leaders of the major businesses on the Australian Stock Exchange. These business leaders, some pictured in front of you, Sydney Airports, Transurbans, the major banks, Oil Search, they come into Morgans to present financial results every 3 to 6 months. And liaising with our analyst team and liaising through us, your advisors, we actually form opinions on their ability to increase strategies, to increase your wealth and increase dividend yield over time. So all the time that I'm presenting information and talking to you, there's a lot going on in the background. Today's economic update, we're going to focus with a few of the media headlines, and the recent one grabbing a lot of attention is Labor's proposal about surplus franking credits. It's very important at this stage to highlight this is a proposal and it's hypothetical in nature, and a lot of water needs to travel under the bridge before this might actually become law. And that includes Labor winning an election with a clear majority. But remember too, at the moment in the 76 seats in the Senate, only half of which will be elected again at the next election, which at the latest will be November 2019, there are 20 senators currently sitting on the crossbench, and the coalition has 30 of those 76 Senate seats. So in order for legislation to get through, a significant proportion of the crossbench must support any proposed legislation that comes through. And that means there are 9 Green senators, there are 3 One Nation senators, and there are 8 individual self-affiliated senators sitting on that crossbench. At the moment, they do not support this proposal. The other stakeholders that need to be dragged into this discussion include such regulatory authorities like APRA. APRA is there to make sure that banks' Tier 1 capitalisation is appropriate. A change in this franking credit legislation could change banks' funding profile, and that needs to be discussed with the government before anything becomes law. So any discussion we have from here on in, please recognise it is hypothetical in nature. The next thing to realise out of this proposal is that if you are in a tax-paying entity, then this proposal actually doesn't affect you. So the cash refunds for the surplus franking credit policy will only affect people on a 0% tax rate. What could those effects be, and what is a good example? Let's have a look at an Australian superannuation fund in pension phase. That's a 0% tax phase. For an $800,000 fund with $250,000 allocated to Australian equities, the franked income that is paid to you is $12,500. If you get a cash refund of that, of those franking credits, your income is actually $17,850. Under this proposal, you could only use the income of $12,500. So it's a significant cut of about a third of the income in a 0% based tax entity. The other thing, apart from reduced income, is franking credits have a way of continually topping up the balance in super. Over 20 years in pension phase, this policy could make the difference between $100,000 as you get out to year 20. So your pension balance will be drawn down more quickly and there will be less income available for you to use. This will have some impact on some asset classes that you might invest in pension phase. We would change our strategies, some of our strategies, based on this legislation, but at the moment it's too early. Please also be aware there's been a lot of backpedaling on this legislation, and already, and this only just came in yesterday, the Labor proposal has started to remove pensioners that may own shares or hybrid notes from being able to collect that franking credit balance back. So backpedaling is happening already. We've got a long way to go on this. Please be aware, but at this stage, it's too early to start changing your strategies. There are also some straight income funds, such as Metric Credit Partners and the Griffin Income Trust, that pay to you direct distributions without the use of franking that are still floating rate. So floating rate means as interest rates go up, you immediately get the benefit of that. So regardless of the legislation, we do have products for you that actually diversify some of your income streams away from franked credit income streams. Next, I'd like to have a look at Trump's tariff policies. Now, once again, the media headlines are trying to steal the attention here to sell advertising space. That's what media does. When we actually do a deeper dive, and these figures on the chart in front of you come from the World Trade Organization, we can see the US, on average, actually has the lowest tariffs of any member sitting on that chart. And it's important to recognise that Europe has tariffs that are 50% higher than that of America on average. And as we go to other countries, which include Australia and China, some of those tariffs can be more than 100% of what the US is actually charging. Now, thinking back to Trump's election platform, he has always spoken about getting a fairer deal for the United States. He's looked at some of their trade strategies and he started to cancel those agreements, and he is looking to get a better deal. And a better deal means that some of these tariffs that the US are charging are so much lower than what happens in other countries. He's looking to negotiate those other countries down. And we believe some of the tariff agendas that you're seeing put forward by President Trump are actually there to deal him a few more negotiation cards as he sits down on the table to negotiate other countries' tariffs lower and get a better deal for America. It's important also too to recognise, and you can read the slide behind me, that this has happened before. In 2002, George W. Bush put up steel tariffs before the midterm elections. What was he trying to do? He was trying to engender a blue-collar vote to keep him in power. He put those tariffs up, and lo and behold, the Howard government said that we support you in wars and we support you economically, and Australia got an exemption. We've seen the exact same thing happen with these Trump tariffs on steel and aluminium. It's also important to remember, when you consider the size of the US economy, $60 billion of tariffs and China responding with $3 billion of tariffs is very small. So just realise this is all about trade bargaining and not about trade wars. America also wishes to protect their intellectual property. And a lot of Chinese markets have only been opened up to US businesses if those trade secrets and intellectual property get released to China. They are seeking to stop this. We have had news about these tariffs in our economic updates for some time. It is one of the risks. So in our good, the bad and the ugly decision making, these tariff negotiations come under the bad section. But in no way do we feel that this will hurt economies in the medium to long term as better deals are negotiated. It's political wrangling at the moment. It does not have an economic effect, but we will continue to monitor. This next phase of the economic cycle is one of the most important things that I want you to be aware of from this economic update. This is huge. For a long period of time we have been presenting that we've been in the recovery, inflation phase of the economic cycle, where central banks and governments have worked towards getting economies recovering, getting unemployment down, getting some inflation back into the system. A little bit of inflation is a good thing. Now, based on many of the characteristics in front of you on this slide, our strategy team have moved us up into the recovery phase of the economic cycle. And the evidence is now overwhelming. We've got interest rates rising in the US and the UK and other countries. In fact, as of last week, we've now had 6 interest rate rises coming out of the US. We've got rising bond yields, growing aggregate demand, we've got rising commodity prices. So be aware, we've now moved in to the recovery phase of the economic cycle. This does change our strategies, but just remember, we have already moved people and prepared a lot of your investments for this cycle already. Because interest rates will be rising, we've got you exposed to floating rate fixed interest instruments. We also have in majority moved people out of utility, infrastructure and property real estate investment trust exposure, as they are bond proxies. We need to find investments now that have cyclical growth, that have growth in earnings, that will have growth in dividend yields going forward. Part of moving into this new phase of the economic cycle has resulted in an adjustment in share markets reacting to this news. On the 6th of February, when the US market had made its original fall of about 10%, we did the volatility call and we explained what was going on. Moving into this new phase of the economic cycle, although many underlying things are positive, with those rising interest rates and rising bond yields, markets need to adjust to that. The US Federal Reserve have made a projection of key economic indicators going forward, including what the interest rates would be. The Fed first put this out in 2016, and markets did not believe that interest rates were going to move up. The Fed has already set down 3 interest rate hikes for 2018 and another 3 in 2019. Those 6 interest rate hikes that they've already done have absolutely had no effect to slow down aggregate demand in the economy and to slow down job creation in the economy. 6 interest rate hikes have not slowed down the US economy at all. So that's what the market is fearing, that the US central banks may start moving more quickly when it comes to interest rate hikes. And prices are merely adjusting to that. But as I said, the underlying fundamental economics is good, and the medium to long-term outlook for growth of earnings and dividends in business are very good. And we covered these points in the volatility call on the 6th of February, so I'm not going to spend a lot of time on them here. But do be aware, as we move into this recovery phase, we get the bull market corrections now coming more regularly. A bull market correction can easily pull the market's pricing back by over 10%. But just recognise in the medium to long term, every time we've seen a 10% fall or more in share markets, we've always seen a bigger recovery over the next 16 to 18 months. In front of you is charts with graphs from 1980, 92, and every year from 2010 to 2014. Expect that this volatility will come through, and then expect, because the fundamentals are strong, that we will see bigger recoveries out the other end. And please refer to my volatility call recordings if you want some more information about how this works. Also, I think it's very important to be aware that the bond yields actually move in 40-year cycles. So here's a graph in the red line going back to the 1920s. And we have just come out of a 40-year cycle of declining bond yields over time, and we expect that to keep rising. And that actually does affect asset valuations going forward. But please be aware, we have had circumstances where bond yields have kept rising over long periods of time, and that has not actually harmed growth in share markets over that period. So yes, we expect more volatility, but we expect more growth to come out of the back of that. The next point I want to make is long-short investment exposure that we've already got you in. And a great example is PM Global Capital. So having a look at the graph here on the left, that is the US S&P 500 indice. And you can see that first 10% fall, a bit of a recovery, and another fall down to that levels. On my right here is the graph of PM Global Capital. The first thing you need to notice is PM Global Capital's share price did not fall as far as the American market, even though they are majority exposed to the investments in the American market. And I want to explore that a bit further. The first thing to recognise is we like listed investment companies like PM Global Capital because they are very transparent about what they are invested in. And we can get a net tangible asset backing, which is their shares and the value of their cash divided by the number of shares, and we know exactly what they are worth every week. As we went through that graph on the S&P 500 and you saw those falls of 10%, please note that the NTA of PM Global Capital hardly moved. It was at $1.40, it went down as low as $1.35, and it rose back to $1.40. How can they do that when they're majority invested in the US market and it's falling? They do that because they can go short. They can sell shares at a certain price, and when the shares fall, they can buy those shares back at a lower price, and they can make money in falling markets. And you can see this extract taken from PM Global Capital down there, that they were 17% short as we entered the volatile market month of February and March. And that is how they were able to maintain their NTA well above market levels. Like it hardly moved. So the share price of PM Global Capital shouldn't have fallen at all, and the share price of PM Global Capital is still very cheap at $1.23 compared to what its net tangible asset backing is at around $1.40. There's also a company commentary there you can see on the slide in front of you. Please read in your own time. We share very similar views to Paul Moore. You saw how effective a long-short investment opportunity was in protecting your capital in down markets. We have other investments like L1 Capital that we're coming out and listing very soon that share those same positive characteristics. So as we enter the recovery phase of the economic cycle, we will be getting more of that long-short exposures in your portfolio. Just a quick look at the Morgan's model portfolio here. You see the balanced model portfolio and the growth model portfolios doing very well and delivering very good returns. There has been a fall in the income portfolio. It hasn't quite kept up with the market. What I do want to say is we have not invested in the bond proxy side of the income model portfolios. So we don't own the utilities, we don't own the infrastructure stocks, so we haven't seen that lack of performance coming through in the income portfolio. I always have examples in the economic update of where I think share prices have fallen not in line with what fundamentals are. And I do 2 or 3 examples each time. Over the next 30 years, I'll get an opportunity to cover the entire ASX 300. Today I want to look at the example of Redbubble, and this is one that I had personally invested in. What was important and what was unique about the Redbubble business model is they have no manufacturing, no warehousing, no distribution costs at all. You buy a product on the Redbubble website, they send a payment to an artist who had posted some sort of artwork or picture on that website, and then that order goes to a third-party manufacturer who produces a t-shirt, a mug, a piece of stationery, with that piece of artwork posted on it. Think about how much more cost is involved with Myer selling a t-shirt, storefronts, staff, advertising. Redbubble has none of those costs whatsoever. So it's also important to note with any stock on the Australian Stock Exchange, they only report financial results every 6 months. So when you see these little red lines, red dotted lines coming through the chart, that is a financial reporting period. And this was the first one for Redbubble. It floated at $1.33, had a good couple of days, but then the share price started moving down. When it came to the first report, those reported results were good. Revenues were growing at over 60%, and new artwork being posted on the website was growing at very high significant rates. Any retail company would be jealous of these figures, yet the share price was moving down, not in line with fundamentals. As we moved into the next reporting period, the second set of line, you can see the share price fell even further. And this was particularly frustrating because when it came to that next reporting season, the growth in revenue, the growth in the key metrics of the company on the slide in front of you were all looking very positive. But the share price had fallen around 33% at this stage. It was starting to look like a good period of time to average down, which I did, and I encouraged a selection of clients to do so. When it came to the third reporting period, once again, the fundamentals of what this company was achieving were extremely strong, yet it was not showing in the Redbubble share price 18 months later. Once again, this is very frustrating, but as Warren Buffett says, short-term price action and short-term movement have nothing to do with long-term value. And this is what these volatility charts are trying to demonstrate to you. By the time we got through to the fourth reporting period, and once again, all the key metrics were exceptionally positive, we saw a large rise in the Redbubble price. It's now 30 or 40% over the value that it floated at 2 years ago, which is a very good return. And for those that average down, they find themselves up 80 to 90%. Once again, a great investment, but it shows you that the share price was disjointed from what the fundamentals were for more than 2 years in this particular investment. Very important to understand. So as we always conclude here, share price does not equal value, and share price can be disjointed from value for long periods of time. And that has more to do with traded volumes on a daily basis than it does actual valuation. Think of a wave of buying meeting a wave of selling every day. And as they push against each other, you get that volatility in the share price happening all the time. That is all that's happening on a short-term basis. On a long-term basis, fundamentals, value, profit, and cash flow are what drive share prices. It's important to recognize some examples here, Get Swift and Big Unlimited, even though their share prices were moving up, that was not reflecting fundamentals at all, and falls came. On some of the other names that we've been looking at with BPS and Sundance Energy, I think those share prices have been manipulated down and definitely do not reflect fundamentals. So we expect recoveries to happen for those particular stories. The next few slides we're going to do is focus on, I had said before that commodity prices were rising. We're going to have a bit of a look at why that is happening. But please be aware that China's policies to clean up their environment are having a marked effect on global commodity prices, or a marked positive effect, and will continue to do so. On a bad day in China, you can see pollution affects large swaths of the country and their neighbours. Their environmental policies have been to shut down inefficient production and inefficient manufacturing, and they have looked to replace those commodities within their own country by going forward to seaborne trade. The light blue line was what we were forecasting for key commodities like thermal coal and coking coal. The red line is what the actual result has been after China started seriously implementing those environmental policies. So commodities are really kicking up. We are looking for active commodity and oil and gas exposure as we move forward, because they will be further benefited by economic growth in the recovery cycle. Now we're having a quick look at the graphs of how the market's actually performed over the last 12 months. So the blue line represents Australia. You can see there's been no capital gains for the Australian market, or even the German market in the green line. The other economies, Japan and the US, were doing well, but this recent correction has started to bring them back more towards Australian performance. And probably a worthwhile point at this time, when we look at the 3-year charts, there's been no capital gain to the Australian share market as we've moved through the last 3 years. That blue line there is flat. Indeed, the only market that's had returns over the 3 years actually looks to be the American market. As we drill into that a little bit deeper, it's important to look at the Australian 4 banks, which represent a large proportion of our market. They are back over the last 3 years by between 20 and 25%. So they're very, very good payers of income, but in terms of capital growth, we've seen them pull back quite a lot over the last 3 years. What's actually driving positive returns in this market? This is where the blue line in the Australian market represents the top 20 largest companies. The brown line, the red line and the green line are the mid-cap indices, the small cap indices and the micro-cap indices. If you want growth, we have to look at the smaller businesses on the Australian bourse to deliver them. Also worth noting is we've seen a little bit of a sell down in some of our hybrid note securities and some of our other fixed income securities over this last little period. You'll see 2 ones there, a Macquarie Bank hybrid security and a Commonwealth Bank hybrid security that have had falls just in the last month or so. Some of these falls aren't any bigger to what we've seen historically, and you can see that in the graphs there, but I just want to have a little bit of a deeper dive as to what's going on. So all these securities paid distributions in March, which can see their prices fall a bit. We've also seen increased volatility in some of the underlying names, the banking names and names like Macquarie. The Labor government has introduced their proposal on franking credits, which has caused some weakness. But I think probably the largest reason here is Westpac and Commonwealth Bank have come to markets with very, very large notes. They've actually demanded between them about $2.5 billion, and that has taken some of the buying out of this market, some of that buying support. As we move into the second half of this year, just be aware that there is $5.2 billion of subordinated debt notes which will be bought back from shareholders and will not be replaced. Some of that $5.2 billion needs to find a home in some of these securities, and we think that will produce a lot of buying support as we enter the second half of this year. So we are not concerned at this stage with some of the falls that we are seeing in the pricing. And there's our revised note strategy of how we will be playing this out for you in 2018. Probably moving forward with a bit of a summary now, markets remain in a sweet spot with very accommodative interest rate policies. We are still at emergency interest rate levels, and those interest rates will rise around the world. We're also very happy with how the economies in Europe and Asia are looking. They're very strong. We're very happy with the US as well. In elements of market volatility, we are looking to take advantage of that. As the share prices slip back, we want to have some cash available and take advantage of that. Here's a fundamental view which hasn't changed as we've moved through the quarter. Please be aware of these. We also, I just want to reiterate that point of just how strong corporate earnings are. Corporate earnings in the US are the highest that they've ever been in history, And we see all these positive circumstances in this recovery cycle, only making them more positive going forward. So the key things that I wanted you to get out of this economic update is, please, as a diversification to our current fixed interest strategies, we are looking at products like Metric and Griffin, which we'll introduce to you over time. That long-short fund exposure is particularly valuable to you as we move into the recovery phase of the economic cycle and we get more volatility coming through share prices. Consider some European exposure. Also consider some infrastructure construction exposure. Also consider some commodity and energy exposure to your portfolios. We also think if you are looking for growth out of markets, you're going to find more opportunities for that in some of the smaller businesses outside of the top 20 businesses on the Australian Stock Exchange. Stay calm. There will be more volatility in the prices of traded products coming through. That will be as true as it is for shares or fixed interest notes as it will be for commodity prices and currencies. Volatility allows opportunity, and we would like to assist you in taking advantage of that over time. The Easter break is coming up. Please have a safe and happy holiday.